Hi, welcome to this Wealth Academy educational series. Learn to invest like the pros. I'm Adam Khoo, your instructor. In this video, we're going to look at the power of stock price trends to profit immensely from this. If you look at prices on a stock chart, they may seem to move randomly. In fact, prices do move randomly, but they often exhibit repeatable patterns that can be exploited. When we can identify these patterns, we can anticipate the direction of prices with a high degree of probability. So prices of stocks tend to move in trends, like the way water moves in a current. Let me tell you what's the truth of the trend. One of the most important principles in trading and investing is that an established trend in price is statistically more likely to continue in the direction of the trend than it is to reverse. So once you're able to identify a trend, whether it's an uptrend or a downtrend, and you can identify when the trend reverses, you can profit immensely from it. In fact, that's how lots of money is made in the markets. So essentially, there are three kinds of trends that a price can move into. The first is known as an uptrend. There are times when the market is in an expansionary phase, when there's growth in the economy or in the company, and the market is optimistic and bullish. So the price will exhibit an uptrend pattern. Now on an uptrend, you notice that prices still fall. But every time they fall, as here, they go higher. They fall, they go higher. They fall, they go higher. They fall, they go higher. So in other words, the price makes higher highs and higher lows. In fact, the definition of an uptrend would be price making higher highs and higher lows. So when the stock's on an uptrend, the probability is that the prices will continue moving higher and higher over time. So what we want to do, we always want to buy the stock or stay in the position when it's on an uptrend. We use the term going long. Going long means buying in anticipation of the price moving up. So when is the best time to go long or to buy the stock on an uptrend? Well, the best time to buy is when the price makes a temporary fall or dip on the uptrend. Because we always want to buy as low as we can in order to make more profits when it moves higher. But we want to buy low on the uptrend, not low on the downtrend. So as you can see over here on an uptrend, there are times when a price makes a temporary low or a dip. So whenever it dips, we want to make a buy. It dips, we make a buy. Every time it dips, we buy in. So we always want to buy the dip on the uptrend, and we never want to buy the high. We never want to buy the high, because when you buy the high, price tends to dip down before moving higher. Now the question is, how do you know it's at the lowest point of the dip? So for example, would you buy exactly here as it's going down this way? The answer is no, because as it's going down this way and you buy here, what if it continues going lower and lower and lower and lower, and it actually is the beginning of a downtrend? That's not too smart, right? So you must always wait for the price to go down enough and bounce off and continue the uptrend. And it should bounce off a key support line or a key supporting moving average. I like to use moving averages. So for example, in this chart, I use the 50, 150, and 200-day moving average. The blue line, the green line, and the red line. And these moving averages are drawn with the computer charting software. So it's very objective. It's based on mathematics. And you notice that when you look at stock prices, they very reliably bounce off their moving averages. So in the case of Visa, it tends to bounce off the 50-day moving average during this period of time. As you can see, it bounces, 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 bounces. So when you see a pattern like that, it is very obvious that the way to make money is to buy the moment it bounces off the 50-day moving average. So we buy over here, we could buy some more here, we could buy more over there. The opposite of an uptrend is a downtrend. So there are times when a market will reverse into a downtrend. During times of crisis, uncertainty, recessions, the market goes into a downtrend phase. The market is pessimistic or bearish. So on a downtrend, do prices still move up? Sure, but every time the price goes up, it goes lower. It goes up, it goes lower. It goes up, it goes lower. So price makes lower highs and lower lows. All right? Now, here's one of the most important rules. You never ever buy a stock when it's on a downtrend. And you never ever hold a stock when it's on a downtrend. Why? Because on a downtrend, probability is that prices will go lower and lower and lower. So no matter how cheap the stock is, never buy it on a downtrend, because cheap can get cheaper and low can get even lower. You never fight the current, never swim against the current will pull you down and you're going to drown. And no matter how good you think the company is, even your father's a CEO of the company, your grandfather's a chairman, don't buy the stock on a downtrend. Always wait for a reversal of trend. In fact, on a downtrend, you want to sell the stock or to do a short sell so that you profit as the price moves down. So when's the best time to sell the stock on a downtrend? Well, the best time is when the price makes a temporary high when it rallies, right? So the price goes up, goes up, goes up, and you sell at the highest point before it collapses. Let it go up, sell at the highest point before it collapses. Now, again, the question is this: how do you know it's the highest point? Because if it goes up like that and you sell over here, that's pretty risky because the price can still keep going up and you're losing money if you're shorting the stock, right? So you want to wait for the price to go up in a short-term rally, hit a resistance, and bounce back down. And you sell only when it bounces back down. And again, the best resistance to use would be a moving average. So again, in this case, for JCPenney, we see the 50 blue, 150 green, and 200 red moving average. So in the case of JCPenney, notice again the price patterns are very predictable. Every time the price rallies to the 150, it gets stuck there, it comes back down. Goes there, hits a resistance, comes back down again. Goes up to the 50, finds a bit of resistance there but can break above it, hits the green again, comes back down again. Hits the green, comes back down again. Hits the green, comes back down again. When you see something like that, it is so obvious the way to make money. The moment it rallies to the 150, it resists it, come down, you short the stock. So you always want to look for stocks with these very repeatable patterns, and that's how you make money on trends. The third phase is stocks can go through a consolidation. And normally, when a stock goes on an uptrend, it will go through a consolidation for a while before breaking out to continue the uptrend, or it may reverse and break into a downtrend. So in the meantime, a consolidation is a phase where the price is neither moving up or moving down. So the market is uncertain. So you can see over here, the price is rallying up, going up, going up. But the moment it hits $49, what happens? Sellers rush in and push the price down. It goes up again, sellers rush in to push the price down. Same thing happens again and again. So that tells you that at this level, there are many sellers waiting to sell. So supply exceeds demand at $49. There's a lot of overhang supply. We call that a resistance. At the same time, the price can't go down very much because every time the price goes down, it hits $37 or so, and buyers rush in and push the price up. They push the price up, and they do it consistently, telling you that $37, buyers are waiting there because psychologically they feel that it's a cheap price, and hence the price is stuck in a consolidation. The general rule of thumb is that you don't want to buy when the price is in a consolidation pattern because it can get stuck there for weeks or months or years. You only want to buy when the price breaks out of the consolidation pattern, like so. When it breaks out, that's called a breakout pattern, and that's when we go long, when it's broken out of the pattern. Or we go short when the price breaks down from the consolidation pattern, and that's when short sellers like to sell the stock. And if you're holding the stock, obviously you want to get out when it breaks into a new downtrend. Finally, you have to understand that there are many kinds of trends. For example, if you look at this chart over here with illustration, what's the trend? Well, if you look at the entire duration, For example, this is 5 to 10 years. It's on a long-term uptrend because it makes higher highs and higher lows, as you can see. But within that long-term uptrend, you have got medium-term trends that last from 6 months to a year and even 2 years. So this is a medium-term downtrend on a long-term uptrend. So if you're a very long-term investor like Warren Buffett, okay, as long as the stock is on a long-term uptrend, like if you look at McDonald's or Apple or Google for the last 10 years, it's on a perpetual uptrend. The Dow Jones Index, the S&P 500, is on a long-term uptrend. As long as you buy a good company, it's always on a perpetual long-term uptrend. If you're a long-term investor like Warren Buffett, you buy anytime because you know the long-term trend will always go up. But if you're a medium-term investor, you will not want to buy during this period. Why? Because if you buy it here, you will see the price going down for 6 months to 1 to 2 years. Although it will eventually go higher in 5 to 10 years, but you don't want your money to get stuck there and not do anything for 6 months to 1 to 2 years. So as a medium-term investor, you only want to buy when it's on a medium-term uptrend, on a long-term uptrending stock. Now, if you are a short-term trader like I am, and I want to make money every month or every 2 to 3 months, I must also look at the short-term trends. So for example, this is a short-term downtrend on a medium-term uptrend. So as a short-term trader, I only want to buy when it's a short-term uptrend, on a medium-term uptrend, on a long-term uptrend stock. In other words, I want all 3 trends to be aligned before I buy. Okay, and that's one of the most powerful ways to make money in the markets, when all 3 trends are aligned. And short-term trends last typically for 1 to 3 months. Let's look at a real-life chart. This is McDonald's. So you can see that in 5 years, McDonald's is on a perpetual uptrend. It makes higher highs and higher lows. But again, within the long-term uptrend, there are medium-term trends. So this is a medium-term downtrend on a long-term uptrend. And if I'm a medium-term investor, I will not want to buy here, right? Because I see my stock going down for a year before ever seeing it going up. I only want to buy when the trend, the medium-term trend has reversed up. Got it? And again, within this medium-term downtrend, you can see a short-term uptrend here, right? That lasts for about 6 months. Can you see it over here? Higher highs and higher lows. So could you buy on a short-term uptrend, although the medium-term trend is down? Well, you could, but we call that a counter-trend trade and it's more risky. So I rather buy on a short-term uptrend over here, on a medium-term uptrend, on the long-term uptrend, where all 3 trends are aligned. Here's the last example, S&P 500 ETF. This is a 10-year chart. Long-term trend is up, making higher highs, as you can see. But those are the medium-term trends. And these are the short-term trends. So that concludes this video where you learn about the different kind of trends. In my other videos, I will teach you how to identify when is the beginning of a short-term uptrend, a medium-term uptrend, and when has it reversed, so you know exactly when to buy and when to sell. And that's the key to making tremendous profits in the markets. This is Adam Khoo from the Wealth Academy Educational Series.